Good morning, everyone. Welcome to this rundown for global stocks and commodities for the 30th of October. In the last week, I think I've had probably a record number of questions from people about what's going on in the market. Lots of commentators now are trying to call a top in the market. There's all sorts of anxiety over the US election, what the Fed will do. There's just so many potential triggers out there that the people have got very nervous, and we're seeing that in the indices pretty much around the world, and certainly as much in Australia as anywhere. We had a very ordinary week, down nearly 3%. So I posed a question, are markets topping? And for those of you that have been watching these videos for a while will know that my mantra is to stay with what is until it isn't. And at the moment, there certainly are some things to be aware of, some potential danger signs. But at this point in time, that's all they are. They're just potentials. So I'm not making a wholesale shift at this stage because we've been fooled, if you like, so many times over the last 4 or 5 years where markets have the appearance of breaking down only to a week or two later basically get right back on track again. And at the moment, I'm not seeing anything which suggests to me that this is any different. However, I do acknowledge that there are some factors out there that do need to be closely watched. And so one of the key things I'll address at the end of this video is how you personally should really deal with what's going on at the moment. And I'd like to thank everyone for the questions that they've sent through, because there's been some really relevant questions, and they reflect the fears and the anxieties that you have out there. So please keep those sort of email questions coming through. So let's take a run through what's been going on. The S&P index was down 15 points on the week, and it finished on the low point of the week, and it's finished right on support. So we really don't want to see too much more downside in the S&P index at this stage. So what I can say is that the long-term trend is still in force, but it wouldn't take very much for the market to break down from here. And of course, once technical levels are broken, then it initiates a whole lot of technical selling that tends to feed on itself for a period of a few days or a few weeks before we reach a new lower level. So I certainly don't rule out that possibility. But at the moment, I'm not prepared to drastically change position. I think the thought of going short heavily is just not advisable at all, because markets could hold these support levels. So the index has remained anchored, and look, it may stay there until after the election. I think there is a lot of conjecture about the outcome of the US election, and until that gets cleared up, then I don't think markets are going to go terribly far. Also, we've seen a stronger US dollar thanks to the rising conviction that the Fed will raise interest rates in December. I'm not convinced of that. I think it's still only a 50-50 bet, but anyway, what I think doesn't matter. The fact is that the US dollar has become stronger, and that is generally not a great thing for the stock market because it affects the earnings of the big multinational companies. But the S&P index is still, as we'll see, is still okay. The Russell 2000 index, though, which is the small caps, is another matter. It has definitely lost momentum. There is no question that there is a move on out of small cap stocks, and either into cash or perhaps into some of the larger stocks. And there's really no reason why it couldn't drop further. So the Russell 2000 is certainly a key one to watch. What if Hillary Clinton wins and life just goes on as normal? If Clinton wins and wins by a more minor majority, then we're going to be in the same situation that we've been in for the last 4 years or 8 years, and that is that the president can't do anything. Clinton won't be able to get her policies through on healthcare and many other things that will not be friendly to the stock market. She'll be another lame duck president, and that's just what the market loves, and life will go on. So that's why at this stage I'm not prepared to make a wholesale change to the way that I'm positioned in the market. Maybe some adjustments could be justified on a personal level, and I'll get to that at the end. But look, you'd have to say that a Clinton win by a modest amount is probably the most likely outcome. If Trump wins, then of course I think the stock market would behave quite badly, at least for a short period of time, because he just brings so much uncertainty to the world. So let's just have a look at those indices, and we'll start initially with this. This is the monthly chart on the S&P. So the low down here is the bottom of the GFC, March 2009. And you can see there's a very, very clear trend channel that's been in force since that time. And we're still in the upper half of that trend channel. So that's just kind of gives you that big picture perspective. The S&P index could fall to around 1960, which is quite a lot. You know, we're currently at 2126. That's about 170 points and still be in the long-term uptrending channel. So, you know, let's not throw the baby out with the bathwater here. The other thing you'll notice too, and this chart has been marked this way for quite some time, I beg your pardon, quite some time, you'll notice that it's marked with a bit of an Elliott wave structure. Now, I'm by no means an Elliott wave devotee, but I think there's certainly some validity to it because it fits with human psychology. You get the first leg higher, which is, you know, a bit of a burst from oversold. We then inevitably get a bit of a correction, which is the second leg. Once that's done, we then embark on the third leg, which is the longest and strongest leg in any trend. And you can see that quite clearly there. You then go into a fourth leg, which is a bit of a complex sort of sideways, bit of a washing machine, is fairly normal. It's not clean and clinical like the second leg down is. So that's typical of fourth legs. And then we've started moving higher in the fifth leg. And the fifth leg can take one of a number of forms. It can be quite short and truncated, and it's possible that this is the top, only just fractionally above the top of leg 3. That's possible. More likely is that it'll push on another couple of hundred points. That's the most likely outcome. So up around the 2,400 mark, perhaps 2,500 is possible. And that certainly would fit with history. So, you know, they're the possibilities. And at the moment, trying to second guess what the market is going to do is just conjecture. Let's zero in on the shorter term. Here's the key breakout level, which occurred back in July. We didn't manage to move too far above it, and since then the market has struggled. So basically since about the middle of August, the market really has gone nowhere. It's gone down a little bit, and we're just sitting on this support level. So this is pretty important right here. Now let's take a look at the important Russell 2000, because this is one that has changed. The Russell 2000 and the Nasdaq were doing better than the S&P over the last 6 or 8 months, but you can see clearly there's a breakdown here. We've now taken out these previous lows. So there's no question that there's a change in character in the Russell 2000. The question is, though, how far further down will it go? Yes, this is a bit of a break, but look, it's nothing dramatic at this stage. And I think it's just in response to what we're seeing with rising bond yields around the world. And we're getting down towards oversold now. We may well get a bounce coming out of that, out of those lows in the coming week. And I must say that this coming week, from a seasonal point of view, not that seasonality is the be-all and end-all, but from a seasonal point of view, we're now into the strongest period of the year. Once America gets over the Halloween holiday, then generally that's pretty typically a strong period. However, this year we've got the US election outcome, and then of course we've got the Fed meeting in December. So there certainly are some other triggers out there. Let's just have a quick look at the Nasdaq. So you can see the Nasdaq is off a little bit, but it hasn't broken support. We need to be down below 47.50 to be definitive on the Nasdaq. Looking at some of the breadth indicators, however, there certainly has been a bit of a deterioration in the Nasdaq and certainly in the Russell 2000. So in other words, the number of stocks that are in uptrend is reducing. So there are a lot more stocks going down than what the index would necessarily indicate. So money has been rotating a bit into the bigger stocks within those indices. But look, nothing dramatic there at this stage. Now, let's take a look at the US dollar. So you can see clearly in a strong uptrend. We got right to the top of that trend channel, and then we reversed back a little bit on Friday. But clearly there's a trend upwards. Now we're going to encounter some resistance back up here at around about 100. The dollar index finished at 98.3. Now you've got to remember that this is not something in isolation. This is not the US dollar valued on its own. It's all relative to a basket of currencies. And a good part of the reason for the US dollar strength is because the euro has been so weak. The euro forms 57% of the US dollar index. So this story is probably more about euro weakness than it is about US dollar strength. Now, as you know, I've been watching the bond market very closely because I think that's where the most meaningful signals will come from. This is the US 10-year yield, and consistent with what we're seeing in the US dollar, we've seen the yield move up, got to a low of 1.34 back in July, and we're now at 1.84. So there's definitely been a significant move in bond yields, which mean bonds prices have been falling. And of course, after 35 years of a bull market in bonds, then this is just way overdue. But let's put it in perspective. So there's the perspective of where bonds used to be. So a huge double top occurred in 2006 and 2007 when bond yields were around about the 5% mark. Let's go back even further, back to the bad old days when bond yields were around 16%, and that occurred in 1981. So let's put what's happening in bonds in perspective when you look at that chart. So we've got, and look, I don't think there's any prospect of us getting back towards those really high levels, but certainly the last peak's around 5% in 2006-7. If we were to get back to those sort of levels over time, then I can tell you the world would look very different, and it wouldn't be pretty. So I don't think that's really on. And so if you look at the rise that we've had, 1.34 to 1.86, it's a move, and some people are starting to fret about the direction, but look, it's not that big a deal at this stage. At the end of the day, we've had one Fed rate hike in 10 years. If they move again in December, it'll be 2 quarter-point rises in 10 years. Let's be honest about what's going on here. So the question is not so much whether the bond market goes down and therefore yields go up. The question is how they do it. It can either happen in a fairly orderly fashion or it can happen in a very disorderly fashion. And the impact on stock markets are quite different for those two scenarios. Now, the other one that I'm also watching very closely is the 20-year, the high yield corporate bond market. Now, this is otherwise known as the junk bond market. And you can see after the last panic, which occurred into early February of this year, when there was a lot of concern about energy companies and whether they would default, and that reached a crescendo at the start of this year, and HYG got down to 75. We've since risen to about 88. It's tailing off now, but and there is definitely a bit of a change in character there. You can see couple of down days and quite elevated volumes. So it's quite clear that some money is coming out of that corporate junk bond market, which of course again, I just think it's way overdue. It should have happened far, far earlier. I'm just amazed that it's up at this level. But it's nothing overly dramatic at this stage. And that would be one of the areas that I'm looking for that would be likely to get hit first. You'll see it in the junk bond market before you're going to see it anywhere else. And at the moment, there's a couple of little red flags, but look, it's just nothing dramatic. If there was going to be a sudden wholesale shift, then we'd be seeing much bigger red candles and probably much bigger volumes as well. So that's my my view of what's going on there. So the essence of a lot of the questions that I've had is around about what happens if Trump wins. Will that cause a market reaction like Brexit, which is a sudden sell-off and then a recovery? I think that's the most likely outcome. Brexit was going to be an absolute disaster, but the markets dive for 2 days and then 3 days later they're back at new highs. So Brexit came to be absolutely nothing, and I'm not sure that that if Trump wins, which I don't think is the likely outcome, that I think markets would return to normal in a relatively modest period of time. The other question I'm getting, of course, is should we go short? My answer to that is not yet. I don't think there's a case to be going short. There may be a case for adjusting your long exposure, granted, and that's a personal decision. But to be going short at the moment, I think is a bit too early. The other question I've had is what will be the impact on gold? It's really hard to know. I focus on the bigger picture drivers for gold. Yes, there might be some sort of short-term impact on gold if Trump wins, but look, I don't know what it is. It's probably not going to be great, and I think it would be, and I mean it's not going to be great in terms of size or magnitude. Could be positive, could be negative. Look, I really don't know. And I'm not spending any time thinking about it. To me, the key drivers for gold are really threefold. There's a number of them, but the main ones are negative real interest rates are good for gold, and we've got that all around the world. We've still got it in America. We've got it in Europe when you take inflation away from the actual interest rates. We've even got it in Australia at 1.5% cash rate, take off inflation. We've got negative real rates in Australia. So that means there's no penalty to owning gold because gold doesn't pay a yield. The second driver for gold, of course, is fear of a financial meltdown, and therefore people are looking for more tangible assets to own, something that actually has value rather than paper, which obviously has an intrinsic value of zero. So that's the second major driver, and of course the third major driver is inflation, and inflation expectations are rising, and that's why we're seeing rises in iron ore, in coal, in copper, in oil, and in gold. So we're definitely seeing inflationary expectations through all the commodities markets. They're by a long way the far more important drivers for gold. So the bottom line is we can't know how it's going to play out with the US election. Don't fret too much about it. Stay with what is until it isn't, is my best advice to you. More money is being lost by trying to avoid something that never happens than anything. So, let's not get too upset about it. I think what you should do is to anticipate if there was some sharp downside, what you personally need to do about that until we know the outcome. Now that's an individual thing, because some people are okay with market volatility and other people aren't. Some people are very nervous about short-term market volatility. Well, if you're that sort of trader or investor, then you probably should cash up a bit and reduce your exposure. I wouldn't be doing anything dramatic, but that's the decision you got to make around your psychology, because you don't want to be nervous, because that just really invites poor decision making. So if you're a bit nervous about the next week or what the Fed decision in December is likely to be, then just reduce your exposure. That would be my advice. So very personal decision. So the far more important question for me, rather than surrounding Trump and whether he wins or not, is inflationary expectations are clearly rising. We're seeing that through commodities. And how will the bond market respond to that? That's really the key question. If we get an orderly decline in bonds, then we're going to see, and we're already seeing it, a rotation from the more defensive sectors into resources and growth stocks, and that's already clearly underway. There's no question about that. The interest rate, high yielding stocks, real estate investment trusts, and other high yielding companies, we've seen those prices come off quite sharply. They've been the worst performing sectors over the last month or two. And money is rotating back into resources and other growth stocks. So that's really clear. We would expect financials to do well, banks relative to others, banks, insurance companies, and the like. And I would expect yield plays to do far worse. So that's if we get an orderly decline in bonds. If it gets disorderly, in other words, if bond prices start to fall quite quickly and there's a panic sell-off, then all bets are off. Look out below. We could see substantial disruption through everything, the bond market, stock market, currencies, the whole lot. I don't believe that's likely to eventuate because central banks have spent the last 5 years doing everything in their power to keep markets steady. And they've been, on record as saying that their policies are around keeping markets steady rather than necessarily being good economic policy. So I can't believe that central banks are just going to sit back and allow that disruption. I think you might see a massive step up in money printing and stimulus, and of course that would be really positive for gold. So they're the things that I'm really looking at in terms of its impact on gold, not whether Trump wins or not. It's turning now to Aussie stocks. Our dollar was up and down a little bit, but finished at the same point as last week, 76 cents. And the index was down by 146, so a poor week in Australia. We're seeing high PE stocks being heavily derated in Australia. So the stocks like CSL and Cochlear and Ramsay Healthcare and Domino's Pizza and all those stocks that have been trading on PEs of 30, 40 and in Domino's case even 60 times earnings, they're all being derated by the market. In other words, the market is saying, look, we're just not prepared to pay that high multiple anymore. It's not that we dislike the company, it's just we're not prepared to pay 35 times earnings. We're only prepared to pay 25. And so the share prices, I think, of those sort of stocks have probably got some more downside in them because that derating process doesn't occur overnight. So if you own high PE stocks, then you really want to take a pretty good hard look at them because that's a process that's underway at the moment. And the prices are coming off no matter how good the story is. And we saw it really clearly last week in Australia. We had a very poor report from HealthScope and their shares got belted, which was fair enough. And Ramsay Healthcare got belted as well just because they were in the same space. The company came out and said, we're absolutely on track, everything's fine. The share price jumped for a day or so, but then went straight back down again. So clearly, even though there was nothing wrong at all with Ramsay, their share price has been significantly derated and it's down from 80 down to 70 and could even go down to 60 before it finds some stabilisation. The other thing that, of course, we're seeing in Australia is that any minor deviations are being punished absolutely brutally by the market. Drops of 15, 20, 25% are common for, in some cases, quite temporary disruptions to the normal sales growth. So you've just got to be really careful these days because the treatment being handed out is more brutal than I've ever seen. However, having said all that, there's always opportunities. We're getting sector rotation, certainly into commodities. So there are opportunities all over the place, but you've got to be pretty open-minded and you've got to be pretty nimble to to get your hands around them. Let's just take a quick look at the Australian indices. So we'll start with the finance index. So again, nothing dramatic, off a little bit. Let's look at materials. Materials doing quite well. As you can see there, they're really quite close to their recent highs. So that reflects the rotation into resources. Let's look at this is XSO, the small cap index. You can see lower highs, lower lows. So it's sort of dropped into a bit of a downtrend. And if we look at the ASX 200, it mirrors a lot about what the banks are doing, but there's been some added pressure on there because of stocks like Wesfarmers, Telstra, and a lot of the other top 50 stocks are well off their highs. Turning now to precious metals. Gold rose by $16 on the week. Most of that occurred on Friday. And we're now entering the strongest and most consistent 4-month stretch for demand, for physical demand for gold, with the Indian wedding season in particular leading the way. So November, December, January, February is clearly the strongest and most consistent period. Fundamental valuations of gold stocks are highly appealing. The companies have done a lot of work to get their costs down, to get their balance sheets in order, get their debt down, increase their resources, and generally just run far better businesses. So their profitability is way up compared to this time last year, and that hasn't really been reflected yet in the share prices. All the key drivers for higher gold are in place. I've talked a bit about that before. But interestingly, the stocks haven't really picked up momentum yet. And as a consequence of that, I think we might see a little bit more of a basing pattern because we're not getting the sort of V-shaped recovery that often happens. So I think if you're quite underweight gold stocks compared to where you want to end up, I think it's okay to start doing a bit of rebuilding down here. But I wouldn't go overboard on it just yet. And I certainly wouldn't count on a repeat of the first half. Now, something might trigger it and gold stocks might absolutely take off. However, I wouldn't count on it at this stage, and I'll show you why in a minute. So my advice would be expect a few months more of sideways action before we really get into the third leg higher in gold stocks. If it doesn't pan out that way, then at least you've got some exposure and you'll be able to participate in that. So let's look at, first of all, at gold. So there's gold on a daily chart. You can see quite a nice little move up there on Friday night. If we look at this on a weekly chart, give you a bit better picture. So yes, that plunge a couple of weeks ago when there was, clearly a bit of manipulation going on was disruptive, but at the moment we've held above. We're still forming higher highs and higher lows at this point. So I'm not perturbed about what's going on with gold. Let's now look at GDX. So we had two support levels here with these green bands. We broke through the first one. We got down to the second one. We've bounced back up. And rather than continuing on, and it's possible we could move higher from here, but it's also possible that we may get a basing pattern. So we get a bit of a W formation here over a period of a few more months. That's possible, and I think that's probably what you should expect. So it's okay to start rebuilding, I think, in the lower half of this band. So on GDX, this band goes from 2250 to 25. I think here and below is okay to start rebuilding, but still keep some powder dry would be my significant advice. Turning to other commodities, copper surged to $2.19, and that was despite a higher US dollar. So quite a good week for copper. Crude oil, however, did break down a bit on US dollar strength, broke down under 49. And this is what I wrote last week, and I think it's still relevant. Crude oil was looking positive, but I made the point that the speculative longs in the futures were still far too high and needed to wash out, as it did with gold 2 or 3 weeks ago. And that part has not yet really occurred to any extent. So I also made the point that perhaps the 45 to 48 area was perhaps a better buying opportunity for energy stocks, and I still think that's very much the case. Okay, let's wrap it up. It's been a bit of a long one, but plenty to talk about. And really, I've put more detail in this week because I just have had so many questions that people really wanted perspective on. My strong advice to you would be to avoid reacting to media speculation. There's a lot of it out there, and most of it is sensational. People jostling, trying to get a headline, trying to make a name for themselves. You've just got to be very careful getting drawn into that. Certainly, there are dangerous triggers out there. They're all over the place. There's a list of them as long as your arm. But they've been out there for most of the last 5 years. There's just some different ones now. So that in itself is not a reason to change your positioning. I think you just need to manage your investments according to a plan. If you're not really clear about what you're doing, then you're in trouble. And I think that's part of the reason why a lot of people do get influenced and do get nervous by media speculation. That tells me that they're not clear and confident in what they're doing. It's a bit like putting. If you're a confident putter, then you see the hole as big as a football and you just knock it straight in. If you're not a confident putter, then you're always trying to second guess, where the line is. And I think it's the same at the moment. If you're not really clear about what you're doing, then naturally you get nervous about what might unfold in the market. And there's just no way that you can trade or invest in that manner. My advice to you would be to ask 2 questions before you act. The first question is my medium-term plan still appropriate for what I'm doing? Or have the circumstances changed? Is a sector that was in favour, is it now become out of favour? And I should be looking at rotating my money somewhere else. If there's no evidence that your medium-term plan is still not appropriate, or is still appropriate, then stay with it. I think it's about as simple as that. The second question is how best to deal with possible short-term disruption. So I'm not saying that you stick your head in the sand and ignore what might happen. I think that's foolish. But have a look at the possibility. Yes, if Trump wins, and the S&P went down 150 points. Or what if the Fed raises interest rates and the market took badly to it and the S&P went down 150 points? How would you deal with that? Does it change your medium-term plan? And for some of you, the answer will be that you need to do nothing. You'll just sit through the volatility. For others who are nervous about that, that's fine too. That's not a negative, and you shouldn't see it that way. Just recognize who you are and what your psychology is about. And if that's the case, then I think right now, then maybe you should be doing some cashing up. You should be reducing your exposure and raising your cash levels. But that's just a personal decision that each individual has to make. So that's it for this week. Sorry, long one, but where the next 6 weeks or so is going to be absolutely fascinating. Lots of potential trigger points out there. There's my contact details for those of you that would want to contact me, and we'll talk again next weekend. Cheers.